Hello and welcome back to Chapter 5, Job Order Costing. We're going to be looking at learning objectives 4, 5, and 6, which are effectively recording the journal entries for the various flows through the job order costing process. So in this video, I will demonstrate the flow of costs that is required for job costing. That is the underlying journal entries that are recorded, which you've seen in Intro Accounting 1, Financial Accounting, and in Chapter 2 of this course, Introductory Management Accounting. However, I will be recapping these journal entries for you at a high level in this mini lecture video as well. I will be doing so by visualizing the movement through the T accounts and then the subsequent operationalization of the journal entries in Excel to show the flow of costs in the job order costing system. Okay, so we discussed previously that we would have purchase and issue of raw materials. Okay, so we would go through our raw materials and they would then go to our work in process inventory through our job costing sheet. There'd also be some raw materials that get used and then are in our actual bucket of manufacturing overhead. So it'll be a debit to the T account here. All right, so let's take a look at that in Excel. All right, so when we are recording actual manufacturing overhead, that means that we are, actually, let's first look at the cost and purchases of our actual materials purchased. So first off, we're going to have purchasing materials. So how does it get into raw materials? So that would be a debit to the raw materials inventory, and that would be a credit to either cash or accounts payable. And that is to record for the flow of direct materials purchase. So from there, we are going to have the cost flows of using the materials. So what happens when we actually use the materials? Well, that's going to decrease our raw materials inventory. So we need to decrease that through a credit. And where is it going? Well, it's going to two places. One is a debit to work in process inventory, and the other place is a debit to actual manufacturing overhead. All right. So from there, let's take a look at what happens next. What happens next is that there's going to be a recording of labor costs. So remember, we are not going to have like a raw materials of labor because we incur labor costs as they have. We can't store them beforehand. So we're going to have an increase directly to the work in process inventory when direct labor is incurred. And the offset to that would be to the wages and payable. So our work in process inventory goes up as people are working on it alongside with materials that they're using for. And that will also increase our salaries and wages payable. So operationalized in a journal entry, the way that we record labor costs would look like this. We would debit our work in process inventory for that direct labor. We also have some direct labor. We also have some labor costs for our supervisors, and our supervisors would go to manufacturing overhead. And so both of these would also increase salaries and wages payable. So if it's directly attributed to the job, then it would go to work in process inventory. And if it's not directly related to the job, but it's still salaries and wages, that is a product cost like a supervisor's salary, that would go to manufacturing overhead. All right, so let's go back to our T accounts and take a peek. So now we are going to have our overhead, which we did discuss. So that would be coming from our indirect labor, which still goes to the same side of the T account, which is going to be our indirect labor, such as our supervisor's salaries and whatnot. All right, so then what do we do once we have all of these costs incurred? So we have our direct materials, which we've pulled out from our raw materials storage. We have incurred our direct labor. We've also then incurred indirect materials to manufacturing overhead. We've incurred indirect labor as well as any other overhead that has come. So any other overhead would be items like our utilities or our plant rent. So then looking at how we're going to record all of that other overhead, let's take a peek. So we have, we're going to increase our manufacturing overhead account, and that's going to be for items such as property taxes payable. So instead of it going to like a property tax expense, it's a product cost, an indirect product cost. So it goes to the debit of the manufacturing overhead account. This might be things like insurance for the building, so prepaid insurance that we're using. This could also look like accumulated depreciation. So again, instead of it going to like an expense account, because it's not being expensed, at least not right away, it is being captured in our work in process inventory via our indirect product costs, via our actual manufacturing overhead. All right, so we have our actual manufacturing overhead. Let's take a peek at what we do next. So we've incurred all these costs, and we have something on our screen that kind of indicates that we're going to incur it, and then we're going to apply it. And that's exactly what we're going to do. So we apply this overhead using that predetermined overhead rate times the cost driver. So in the last example, in the last video, we had an overhead, predetermined overhead rate, and then we determined what that rate was, and we times it by the number of direct labor hours that job used to get the amount that we were going to apply to this job. So when we apply it to the job, we are going to do the following journal entry, and that is we are going to decrease our manufacturing overhead account, and we are going to increase our work in process inventory because we're taking it from that T account. We're reducing the T account for manufacturing overhead, and we are putting it to work in process inventory for that job so that that job gets, you know, an estimate of its fair share of the total overhead. Otherwise, we would be under costing. Okay, so then what happens when actual manufacturing overhead applied overhead incurred doesn't equal the amount applied? Well, it likely isn't going to be equal because remember, this is a best guess of total estimate cost divided by total estimate cost driver, and then these are actual costs incurred. So if these are ever zero, that would be like a cause for concern because like how did you forecast exactly what you're going to incur and whatnot throughout the year? So since these are likely not going to be equal, there's going to be a year-end adjustment, and that will be something that we will cover in a future video. Okay, so now, so this whole purpose, you might hear something referred to as a clearing account. Manufacturing overhead is a clearing account. It's a place that we collect the actual charges. We then apply an estimate. So we have ins and outs, and nothing at the end of the year should be in this account. So there should be nothing in the manufacturing overhead account at the end of the year, which is the reason it's referred to as a clearing account. Okay, so we are also going to have non-manufacturing costs that are not going to be assigned to individual jobs. So that's because they're not manufacturing costs, they're not product costs, they're not assigned to the jobs, they're going to be expensed in the period incurred. And for a fulsome demonstration, because we did all the journal entries before, let us continue with showing some examples of journal entries. This should be nothing new. This should be related to your intro financial accounting. So this might be things like the CEO expense. So you would debit salaries expense because the CEO isn't in there rolling up their sleeves and creating products. They're not cutting the toilet paper. So there would be debit salaries expense, so straight to the income statement. credit salaries payable. Okay, what about advertising expense? Well, same thing, selling general and admin. We're going to debit the advertising expense, and we are going to credit accounts payable. All right, great. All right, let's continue. So we're going to have now, we're going back to our product costs. We now have our direct materials, our direct labor, and our overhead applied in our work in process inventory. When we actually finish our work in process inventory, this goes to our finished goods inventory, which we saw in our chapter 2 video. So then we would go and we would say, cool, you're done being manufactured. That means that you're done. So let's take that out of work in process inventory, so credit work in process inventory, and let us debit our finished goods inventory because you're done. You were manufactured and these are your costs. Cool. All right, I think you know where this is going, but we're going to keep going. Now we have our finished goods inventory. When we actually sell it, we reduce our finished goods inventory and we put it to the cost of goods sold on our income statement. So last journal entry of the video, cost of goods sold. This should be familiar. So we would go, we would first recognize the sale. So we're like, oh, thank you so much for the AR for the sale, and recognize the sale. And then we would also recognize the cost of goods sold and the reduction of our finished goods inventory. And so what does our profit, our gross margin profit look like for that sale? Our gross margin profit would be the sales less the cost of goods sold, and then minus all of our non-manufacturing costs, our selling, general, and admin. So, but just on a product by product basis, did we make money off of this job? What did we sell it for? What were the costs incurred? All right, thank you so much. I will see you in the next video where we'll figure out what to do with that, with that manufacturing overhead. What happens to the difference between what we applied and what we actually incurred? Talk to you soon.